If investing with low expenses, broad diversification, and little work on your part sounds like the perfect way to invest, it's time to learn about index funds. This passive form of investing enables just about anyone to jump into the market with little knowledge and earn average returns. An index is a composite of hundreds or thousands of stocks or bonds. It tracks the overall performance of all companies in the index rather than individual investments. The S&P 500 is the most common example of an index, as are the Dow Jones Industrial Average and Nasdaq. An index fund is a fund that tracks a market index. It's a hands-off investment that diversifies your investments and typically provides decent returns. Index funds don't promise to beat the market or provide higher than average returns. They work to mimic the market while reducing your risk. It's the perfect way to diversify your investments with little work on your part. Index funds are passively managed, unlike mutual funds, which are actively managed. In other words, mutual funds try to beat the market by constantly buying and selling investments. These don't have a human manager buying and selling funds. Instead, a computer puts the fund together, rebalancing it as necessary to mimic an index, not beat it. Each index fund comprises a certain number of stocks and bonds based on the index it's trying to mimic. It's well diversified, which means even when one stock or bond does poorly, another asset will offset it, so you don't have major gains or losses, but rather meet the market's return. What are the benefits of index funds? Number 1. Low fees. Because they aren't actively managed, the fees are much lower. You aren't paying a human advisor to actively buy and sell investments. Instead, you invest in the fund, and it remains as is except for the necessary rebalancing. Because of the lack of management, the fees are much lower. Number 2. Immediate diversification. Index funds make diversification easy and automatic. You don't have to determine which stocks and bonds offset one another. The index does it for you as you invest in hundreds or even thousands of investments in one index fund. Number 3. Rewards for long-term investors. If you invest for the long term, at least 10 years, you should see an average 10% return. This is much better than investing individually in most stocks and bonds, which are unpredictable and often cause investors to bail early. With a diversified fund, you offset the ups and downs, realizing an average return over the course of 10 years of 10%. Number 4. Not as volatile. You won't see your investment tank if one company does poorly like you would with individual stocks. You offset the risk by diversifying your investments. You'll see fluctuations, but they won't be as drastic as they would with individual funds. Just a reminder that all index funds have fees. Read the fine print to know the full fees of a particular index. Most have what they call an expense ratio, which incorporates all fees for the investment. The fees are often much lower than mutual funds since they are passively managed. While no investment is 100% safe, index funds have diversification on their side. When you diversify your investments, you offset the negative with positive effects from another investment. Any investor can benefit from an index fund, whether you normally actively invest or you're just starting your investment journey. It's a great way to keep your portfolio diversified and keep more of your money in your pocket, rather than lining the pockets of fund managers. If you liked this video, then make sure to hit the like button, subscribe, and join us every week as we break down personal finance topics in plain English.